Welcome back, investing mutants. This week's video is on the Box.com tender offer that was recently announced, and I'll give you my thoughts and perspectives on this particular company. Check it out. Hey everyone, welcome back to another edition of my YouTube channel on special situations investing and my personal investing practice. As a quick disclaimer, this video is for educational purposes only. Any companies that I mention in this presentation are discussed solely for illustrative purposes. Discussing such companies and the specifics about them is to help educate me and educate you about certain special situations. It is not a solicitation to purchase them. I recommend that you conduct your own research and identify why you might want to own the company yourself prior to your committing of any funds. I also recommend that you seek the services of a financial advisor that has considered your personal situation as your fiduciary. And then finally, may your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks a bunch for watching. Now on to the video. Awesome, so quick little update on the Box.com tender offer. So Box.com just this past week, maybe a couple of days prior to that, they talked about their Dutch tender offer. They finally announced it. I've been waiting for this for a couple of months now. And their Dutch tender offer had a couple of details that I'll share with you, and then I'm going to spend a little bit of time just looking at Box.com itself and a couple of thoughts on would-be longer-term investors. With their tender offer filing release, Box.com has announced that they will have a Dutch tender offer, and the Dutch tender offer goes for $500 million in shares, which represents about 13% of the shares outstanding. And it is an offer to purchase shares between the prices of $22.75 per share and $25.75 per share. I first talked about the Box.com tender offer when I looked at another tender offer that they had for KKR to purchase preferred equity in the company. KKR put an investment for the same amount, $500 million, for shares outstanding in this. But if you want to see the actual video and my thoughts on that initial announcement, you can go ahead and check out the video. I'll make sure that there's a link in the description and also in the show notes for this. Around that time, I decided to do what I called a pre-tender offer purchase, and this is kind of getting left of launch, basically, where I'm trying to purchase prior to the announcement, because often when you purchase prior to an announcement, then you benefit from the announcement going in your favor. This is a little bit riskier, and so I didn't put as much of my funds into the company at the time. I put about 6% of my total outstanding shares, or excuse me, my total outstanding account value into the company. And I went ahead and purchased it on the thought that it should turn out all right. My overall cost of shares turned out to be $21.86 per share on average. And at the current price today as of this video at $25.18 per share, that represents about a 15.18% return. The interesting thing about having these couple of months to look at Box.com, it's caused me to do some introspection, some look at the company and whether or not I might want to keep the company for a long-term investment. Well, I went ahead and took that look, and a couple of things really stood out to me. First and foremost, over the last 7 years, from January 2014 to January 2021, the overall revenues of the company changed from $124 million in the beginning of that time to over $770 million. So the growth for this company has been excellent. And over a 7-year period, almost 7 times, it's about 6 times your earnings over that same time period, is pretty darn good. And that always causes me to be interested. and I looked at the cash flows on the company, and the cash flows are starting to go positive with the company. So back in 2014, it was kind of pre cash flow positive era for it. Now the cash flow has gone up quite significantly. They're still spending a lot of money on research and development and all the other things that go into this company. So there is definitely a lot of money that's going into it, and that's to be expected with companies in the newer technologies. With that in mind, though, I looked at the shares outstanding. So if you look back at that same time, January of 2014, the shares outstanding for the company were 10.9 million. Well, today, shares outstanding for the company are 159.86 million. So does that mean that the company has done better overall? Absolutely. Operations for the company has been excellent. But when we talk about capital allocation and whether or not the common shareholders' interests have been protected, not a chance. The common shareholders' interests have basically been diluted over and over and over and over again, which is why if you look at the share price, it's kind of been range bound over the past 6 years. Now, I think that might have been the reason why a company like Starboard Capital got involved with the investment, and it may even be the reason why KKR has gotten involved in this. So both KKR and Starboard Capital are significant shareholders in the company. Both of them have done what they can to kind of protect that interest in the company. And part of the activity, especially with KKR, is that they've gotten board members to hopefully protect their interests for the company. In the world of self-interest, however, just note that KKR's investment is preferred shares. And with those preferred shares, they are not going to protect, let's say, the shareholders' interests of the common equity over their own. Now, with the ability to convert, that does give them an incentive to lower the expansion of common equity in the company over time, but they are going to continue to they're going to protect their own interests well before your own if you decide to buy this as a common shareholder. With that in mind, I'd like to end this video on one final note, and this comes from Warren Buffett, Oracle of Omaha, talking about his experience with issuing common equity in order to buy some of the insurance companies back in 2017. He said, "I would rather prep for a colonoscopy than issue Berkshire shares." And when we're thinking about shareholders and we're thinking about people that are trying to take care of us and we want to protect our investment, I just want you to be aware that if you have a company that continues to issue shares, yes, in a growing industry, that's probably a good thing, but eventually it comes due to the equity holders, and you're the ones that lose out. If we had only 10.9 million shares of Box.com today, the thing would be astronomically more valuable than what it is right now. So anyway, thanks for watching, guys, and we'll catch you next week. Good luck with your investments.